$80 silver is coming. Here is the two-phase plan you need now. Has the financial world reached a moment of truth for its most enigmatic precious metal? Silver, a commodity that has languished in the shadow of gold for decades, has now breached a barrier that has stood as a monument to investor heartbreak for nearly half a century. The $50 mark, a psychological summit last seen in fleeting, fever-dream moments, has been crested. This is not just another tick on the commodity charts. It is a profound signal that the fundamental dynamics governing this metal have irrevocably shifted. The question is no longer if silver will move, but rather how one should position for the seismic volatility that history tells us is about to be unleashed. The answer will determine who profits from the coming mania and who is left holding the expensive remnants of a cautionary tale. For well over a decade, the narrative for silver has been one of persistent disappointment, a story of perpetual potential shackled by market realities. For every long-term holder who viewed it as a store of value, there were countless others trapped in positions that were deeply underwater, purchased during the euphoric 2011 price spike. This prolonged period of consolidation, a 14-year winter, created a deep-seated psychological problem in the market. It conditioned investors to view silver not as a dynamic asset, but as a stagnant holding, a poor man's gold that perpetually failed to launch. The opportunity now presenting itself is born from the ashes of that frustration, as the metal awakens from its slumber with a ferocity that few were prepared for. The catalyst for this monumental shift is not a singular event, but a powerful confluence of forces that distinguishes this rally from anything witnessed in the modern era. Unlike the speculative mania of 1980, driven by the Hunt brothers' attempt to corner the market, or the 2011 spike, which was largely a monetary phenomenon fueled by post-financial crisis quantitative easing, today's ascent is built on a dual foundation. On one side, we have the traditional safe haven demand, as investors flee from currency debasement and geopolitical uncertainty. On the other, a voracious and ever-growing industrial demand serves as a powerful, non-negotiable floor under the price, something that was fundamentally absent in previous rallies. This industrial demand component cannot be overstated. It is the bedrock of the new silver thesis. The global push towards green energy is inextricably linked to silver consumption. It is an essential component in the manufacturing of photovoltaic solar panels, and with nations worldwide committed to expanding their solar capacity, this demand is structural and inelastic. Furthermore, the electric vehicle revolution represents another massive draw on silver supplies. Every EV unit contains a significant amount of silver, and as the transition away from internal combustion engines accelerates, so too does the baseline demand for the metal, creating a supply-demand imbalance that grows more acute with each passing year. The tipping point for silver appears to be the market's collective awakening to this structural deficit. For 7 consecutive years, global silver demand has outstripped supply from mining and recycling. This persistent shortfall has been quietly drawing down available above-ground inventories, tightening the market to a breaking point. The breach of the $50 level is the shot heard round the financial world, a signal that the available supply is no longer sufficient to satisfy the combined forces of industrial consumption and renewed investor interest. This is the moment where the change becomes irreversible, attracting a wave of momentum traders, algorithmic funds, and mainstream media attention that can fuel a parabolic advance. The immediate impact of crossing this threshold is a dramatic psychological shift. $50 was not merely a technical resistance level, it was a graveyard of past ambitions. Conquering it decisively changes the perception of silver from a laggard to a leader. We are already witnessing its outperformance against gold, a rare occurrence that signals a major revaluation is underway. The gold-to-silver ratio, a historical measure of relative value, has been contracting sharply from its historically high levels, suggesting a powerful reversion to the mean is in progress. As silver begins to lead the precious metals complex, it draws in capital that was previously hesitant, creating a self-reinforcing cycle of higher prices and increased investor participation. The aftermath of this breakout will likely unfold in 2 distinct, dramatic phases. The first is the moonshot, the fun part of the story. A rapid run toward $60 seems almost preordained, as this initial surge captures headlines and creates a sense of urgency. The momentum from that move could easily propel the price toward $80 or higher in a remarkably short period. Fantastical stories will circulate, and predictions of triple-digit silver will seem not only plausible but imminent. This is the phase where discipline is most critical, as the fear of missing out reaches a fever pitch, tempting even seasoned investors to chase the rally at increasingly dangerous altitudes. Consider the mathematics of such a rally for an existing holder. An investor who accumulated 200 ounces at an average cost of $30 is sitting on a comfortable paper profit. However, the temptation to add to that position is immense. Buying another 100 ounces at $55, including premium, immediately raises the average cost basis to over $38. As the price rockets toward $80 and they continue to buy into the excitement, that average cost creeps ever higher. This behavior, while emotionally satisfying during the ascent, sets a dangerous trap for the inevitable correction that follows every parabolic move. History provides a sobering blueprint for the second phase, the crash. Following the 1980 peak near $50, silver collapsed by an astonishing 90% over the next 4 years, leaving a generation of investors decimated. The aftermath of the 2011 rally was less severe but equally painful, with a 70% drop in value by 2015, wiping out years of gains and leaving anyone who bought near the top significantly underwater for over a decade. While the fundamental picture is stronger today, the speculative fervor that drives a parabolic spike is rarely rooted in fundamentals alone. When that investor-driven momentum exhausts itself, a deep and painful correction is all but guaranteed. The central lesson from these historical episodes is the stark difference between a speculative spike and a sustainable price level. An $80 silver price driven by a speculative frenzy does not represent a new fundamental value. It is an overshoot, an emotional extreme that the underlying market cannot support. If we conservatively assume a 60% drop from a hypothetical $80 peak, less severe than previous crashes, we are left with a sustained price of $32 an ounce. This becomes the new reality after the tourists have gone home, and it is this number that strategic investors must anchor their decisions to. For the hypothetical investor who held their original 200 ounces, a new floor of $32 still represents a profit. They have successfully ridden the wave and can continue to hold for the long term, their core thesis intact. However, for the investor who aggressively chased the moonshot, raising their average cost to $38 or more, this $32 aftermath is a disaster. They are now upside down, having transformed substantial paper gains into a real-world loss. This is precisely the experience of most who played the 2011 rally, and it serves as the ultimate cautionary tale for the current cycle. The key takeaway is the imperative of defining one's strategy before the peak of the emotional cycle. Every participant in this rally must decide which game they are playing. Are you a long-term holder, treating silver as a form of financial insurance and a hedge against inflation? Or are you a trader, seeking to capitalize on the coming volatility for profit? These are two entirely different objectives that demand two very different approaches. The fun part of the rally, the potential for life-changing gains, only applies to the silver that one is emotionally and financially prepared to sell. Profit, after all, is only realized when a sale is made. A prudent strategy may involve a bifurcated approach. A core position, the stack, is held for the long term, insulated from the emotional turmoil of the market's gyrations. This portion is your anchor, your hedge against systemic risk. A separate tactical position is then managed with the express purpose of trading. This is the portion you buy with the intention of selling into the rally's strength, seeking to exit somewhere near what you perceive to be the peak. This allows an investor to participate in the upside and realize tangible profits without compromising their long-term strategic holdings. Swapping a portion of highly valued silver for gold near the peak of the rally is a classic and historically effective strategy. As the gold-to-silver ratio plummets during a silver mania, it presents an opportunity to convert an outperforming asset into a more stable one. Selling silver at a ratio of, for example, 40 to 1, and using the proceeds to buy gold allows an investor to lock in their gains in an asset that is far less likely to experience a 70 to 90% collapse. This rebalancing act is the hallmark of a sophisticated precious metals investor who understands the unique personalities of both metals. It is impossible to perfectly time the top of any market, and attempting to do so is a fool's errand. The goal is not to sell at the absolute peak, but to sell into strength when the market is euphoric and bullish sentiment is at its maximum. Waiting for the top to be confirmed means you will, by definition, be selling on the way down, often into a panic. The better approach is to set realistic price targets on the way up. Selling a portion of your trading stack at $65, another at $75, and so on, ensures you are taking profits while the market is still climbing, mitigating the risk of being caught in a sudden and violent reversal. The macroeconomic environment provides further fuel for this silver rally, reinforcing the notion that this cycle is fundamentally different. We are in an era of unprecedented global debt, persistent inflationary pressures that central banks are struggling to contain, and escalating geopolitical tensions. In such a world, the demand for tangible, safe haven assets is not a fleeting trend, but a long-term structural shift. Unlike in 2011, where the primary concern was the fallout from a single financial crisis, today's risks are broader, more systemic, and more entrenched, suggesting a more durable and sustained bull market for precious metals. Furthermore, the investor landscape has matured significantly since the last major rally. The proliferation of exchange-traded funds, or ETFs, has made it easier than ever for both retail and institutional investors to gain exposure to silver. This increased accessibility broadens the potential investor base, allowing for much larger capital inflows than were possible in previous cycles. We are already seeing record inflows into silver-backed ETPs, a trend that is likely to accelerate as the price continues to garner mainstream attention, adding yet another powerful accelerant to the rally. The supply side of the equation offers little relief for the growing demand. It takes, on average, 10 to 15 years to bring a new silver mine from discovery to full production. Decades of relatively low prices have disincentivized investment in exploration and development, leading to a pipeline of new projects that is alarmingly thin. Consequently, the mining industry is simply unable to respond quickly to a surge in price. This inelasticity on the supply side means that any significant increase in demand must be met by drawing down existing stockpiles, a process that only serves to exacerbate the price squeeze. Let us not forget the psychological impact of inflation-adjusted prices. While the nominal price of $50 an ounce matches the peaks of 1980 and 2011, the real value is vastly different. The $50 reached in 1980 is equivalent to nearly $200 in today's currency. The 2011 peak is equivalent to over $70. From this perspective, the current price is not a ceiling, but a significant milestone on a journey to retest its true, inflation-adjusted all-time highs. This context suggests that the rally is not in its final innings, but is perhaps just beginning to break out from a multi-decade consolidation. The performance of silver relative to traditional financial assets also warrants careful consideration. While the narrative of precious metals outperforming stocks is often skewed by the chosen start and end dates, the recent trend is undeniable. Since the beginning of 2020, both gold and silver have shown robust performance against major stock indices like the S&P 500 and the Dow Jones. The recent surge in silver has seen it decisively pull ahead of even gold, an emphatic statement of its current market leadership, and a signal that a significant repricing relative to all other asset classes is now in motion. The coming months will be a period of immense opportunity and significant peril. The rally will create substantial wealth for those who approach it with a clear strategy, discipline, and an understanding of historical precedent. It will be a joyous, celebratory time for those who have patiently held the metal for years, waiting for this moment of vindication. It will be an exciting, adrenaline-fueled ride for traders who successfully navigate the incredible volatility. The narrative will be compelling, the gains will be breathtaking, and the temptation to believe that this time is different will be almost irresistible. However, the rally will also inevitably leave a trail of destruction in its wake. It will lure in novice investors at the peak of the frenzy, individuals driven by greed and the fear of missing out, who will buy at $80 or $90 an ounce, convinced they are on the path to riches. It will punish those who fail to take profits, those who hold on through the peak and all the way down the other side, watching their gains evaporate and turn into losses. The nature of a parabolic spike is that it must eventually correct. The market is a brutal teacher, and the lessons of 1980 and 2011 are about to be taught to a new generation. Ultimately, every investor controls their own destiny in this unfolding drama. The way you approach this rally will determine which of the two groups you fall into, the one that profits or the one that is left holding the bag. It requires an honest self-assessment of your goals, your risk tolerance, and your emotional fortitude. It requires the discipline to sell when every instinct is screaming to buy more. It demands an awareness that the most dangerous moments in a market are not during the crashes, but during the euphoric ascents when risk is forgotten and caution is thrown to the wind. Therefore, as you decide how to celebrate this historic breakout, consider celebrating with a plan. Formulate your exit strategy now before the mania takes hold. Define what percentage of your holdings is for trading and what is for the long haul. Set your price targets for taking profits. Decide if and when you will rebalance into other assets like gold. Do the hard work of strategic planning while your mind is clear and rational, so that when the market becomes a chaotic whirlwind of emotion, you can execute your plan with the confidence and discipline of a seasoned professional. The future of silver will be a tale of two very different stories. The first is a thrilling, high-octane narrative of a moonshot, a period of explosive gains that rewards the brave and the prepared. The second is a cautionary tale, a painful reminder of the brutal physics of financial markets, where every parabolic action has an equal and opposite reaction. The $50 breakout is not the end of the story. It is the beginning of the most critical chapter. How you navigate it will make all the difference. This is decision time. Looking further into the future, beyond the immediate spike and subsequent correction, the outlook for silver's baseline price remains exceptionally strong. The enduring structural deficit, coupled with relentless industrial demand from green technologies, provides a fundamental support level that is far higher than what we have seen in the past. After the speculative froth is blown off, the market is likely to find a new, higher equilibrium. The $32 floor calculated from a hypothetical crash may itself prove to be a conservative estimate in a world that is increasingly reliant on silver's unique properties. This duality of silver, as both a monetary metal and an indispensable industrial commodity, is its greatest strength. While investment demand can be fickle, rising and falling with market sentiment, industrial demand is sticky. Factories building solar panels and electric vehicles will require silver regardless of whether the price is $30 or $80 an ounce. This constant, underlying bid provides a degree of stability that was absent in purely monetary-driven rallies of the past, suggesting that while a significant correction is likely, a complete collapse to pre-rally levels is not. One must also consider the geopolitical landscape and its influence on supply chains. A significant portion of silver production comes from countries that can be politically unstable. Any disruption to mining operations in key regions like Mexico or Peru could have an outsized impact on the already tight supply-demand balance, potentially triggering another sharp leg up in price. This geopolitical risk premium is an often overlooked factor that adds another layer of bullish potential to the long-term outlook for the metal. The currency markets will also play a crucial role. Precious metals are priced in U.S. dollars, and there is a well-established inverse relationship. As central banks, particularly the U.S. Federal Reserve, are forced to lower interest rates to manage ballooning debt loads, the dollar is likely to weaken. A declining dollar acts as a powerful tailwind for silver, making it cheaper in other currencies and boosting global demand. This macroeconomic backdrop is highly supportive of a sustained, long-term bull market in precious metals, even after the initial speculative frenzy has passed. In conclusion, the breach of $50 silver is a paradigm-shifting event that investors must treat with both excitement and extreme caution. It signals the beginning of a potentially historic price run, underpinned by the strongest fundamentals the market has seen in generations. There is an opportunity for tremendous profit for those who understand the game they are playing. However, the ghosts of 1980 and 2011 loom large, reminding us that such parabolic advances are inevitably followed by severe corrections. The challenge and the opportunity is to participate in the ascent while skillfully avoiding the calamitous descent that is sure to follow.